We're going to talk a lot about China today on the program, a topic that we sometimes talk about when we thought it would be interesting to sort of delve into the deep end of the pool and talk about what's going on over there. A lot of headlines, whether it's this Evergrande conversation about this property development company that sort of missed a payment to its bondholders, and then really more of a conversation about China in general and what its role should or should not be in your portfolio. We're also joined again this week with our fellow certified financial fiduciary, who also happens to be a CPA at Nelson Financial Planning. Kristen Cayley is joining us to sort of finish the conversation that we started last week about what's going on with some of these tax proposals in Washington. Last week on the program, we talked about some of the changes to the income tax rate, just the capital gains tax rate. This week, we're going to cover some of the potential changes to some of the other types of taxes that may come up on your return. So that's what's on cue for this week. Before we get started with all of that, we thought it only important to take a moment and talk a little bit about market behavior of late, right? So if you're watching the markets on a regular basis, you know that we've certainly seen an uptick over the past few weeks about volatility. And one of the things that we want to kind of talk about in this little segment is, at the end of the day, there's this battle, if you will, that is waging on the economic front that then correspondingly impacts the markets. And that battle is this conversation we've been talking about a lot on the program over the course of the past many months. And so in one corner, if you will, we'll do this as a boxing match for our friends on 96.9 The Game. That's the sports channel. So we got to have a sports angle to this, even though we're talking about finances. So in one corner, you have the consumer. And the consumer, well, he's been trapped at home. He's got a lot of cash, and he's ready to go. Ready to go. Okay? Weighing in on the other corner is the result of his desire to spend, and that is the concept of inflation. Inflation sort of hand in hand with interest rates. So that other corner, they got a couple of different fists going, if you will, because that other corner has not just inflation, but interest rates. Because one of the things about interest rates, or at least if you're the Federal Reserve, is you're supposed to be watching inflation, making sure that inflation doesn't get too high. And if it does, then you've got to raise interest rates. So when you do that, that generally slows down the economy. So there's your boxing match, there's your boxing analogy. And so what's playing out in the markets, particularly over the course of the past few weeks here, is this back and forth. Like one day, somebody's landing a right hook, right? And then the other day, the next day, and oftentimes the very next day, it's coming in with a jab, if you will. It's about all the boxing terms I know, so I got to kind of cut the analogy short. But the point is this: when the headlines are focused on the consumer and demand and growth, the markets are moving upward. When the headlines are focused on the inflation and higher interest rates, they are reacting. And what's funny about the pattern, and this is all kind of part of the normal pattern, is that one day one will prevail, and then the other day the other one will prevail. So that's the first comment that we would make about volatility in general, is that volatility always has two sides. It goes up and it goes down. When you get to a point where there's additional volatility in the market, what you'll find is that the very worst single days in the market are very much clustered around the single best days in the market. So know that volatility has two parts and always has two parts. It can mean that the market's going up quickly. It can mean that the market's going down quickly. During those periods of time, the last thing you want to do is hop out on the down days, because you're going to fundamentally undermine your long-term investment results. Here's the thing, though, that makes it really hard. The media loves negative news. So the down days in this volatility cycle are going to get much greater emphasis than the up days. So maintain that perspective and understand that volatility loves company. Once you go through a period of time where there hasn't been much volatility in the markets, what we usually see is that volatility, when it starts, it kind of hangs around for a few weeks and then dissipates. So just be aware of where we're at. We've had a period of time where the first 8 months of the year, there were no less than 50 new highs in the markets. It's only normal for things to kind of take a breath here and see that increase in volatility, especially with this boxing match that's waging out there between the consumer and inflation and interest rates. So comments on volatility to start us off. We'll shift gears to the story about a company. And this is a company that perhaps you have heard of, particularly over the course of the past couple of weeks. It's a company by the name of China Evergrande Group. They are a private sector Chinese property developer and home builder. Last year, they had $78 billion in revenue. They've got hundreds and hundreds of projects in more than 200 different Chinese cities. They are an enormous company that is embedded into the Chinese economy, Chinese society. The problem is that, as opposed to what's going on here in Florida, where home sale values are going up like nobody's business, in China, the opposite of that is happening as a result of the pandemic. The pandemic there truly hurt house sales. And in fact, in China, home sale values have actually declined by 20% over the course of the past year. Now, that presents a headache if you are a major home builder and property developer, right? So particularly if you've been borrowing a lot of money, and that's certainly the case for China Evergrande, heavily indebted, $88 billion in debt. 42% of that is coming due in less than a year. So not only is it heavily in debt, it's got to start paying some people off right away. They have pre-sold an estimated 1.4 million apartments worth over $200 billion. And those projects hasn't yet been completed, although people have put money down. So you get the idea. The total debt burden of this company is the most of any publicly traded real estate management or development company in the world. So big dollars. So last week, it missed an interest payment to its bondholders, and the Chinese government's response was kind of a little bit of a yawn. In fact, apparently Chinese officials were telling local officials to prepare for the storm, if you will. No real intention of bailing this company out, not interested in helping. After years of flooding the market with cheap money for real estate development and sales, government of China kind of stepping back and saying, we're going to let it play out as it is. Almost like a Lehman Brothers-esque type of reaction from the Chinese government. Now, here's the postscript on it. The latest update is that the company basically kind of got forced into selling some stock of a state-controlled bank that the folks at Evergrande had previously invested in. They owed a lot of money to that bank as well, so they wound up being sort of forced to sell that stock, sort of a forced liquidation. That alone raised about $1.5 billion. But that's an individual company, but it speaks to the broader issue that is China. And an industry, a company, an executive can go from favored status to jail in the blink of an eye. So what's going on? Well, we're going to talk about it. We're going to take a break. We're going to come back and we're going to talk a lot about sort of what's going on in China, the economic, the political, and what investors need to know in terms of what their allocation to China really should be looking like. Coming up next here on Dollars and Cents. So here are the numbers when we talk about China. U.S. mutual funds in particular love China. Mutual funds, indexes, ETFs, they love China. Those funds that invest primarily in China, so here are the numbers, held $43 billion in net assets, which was up 44% from the prior 12 months. Of that, during that same 12-month period of time, investors added $13 billion in new money. Okay, but here are the numbers. Since the inception of the MSCI China, which is the index that generally measures the performance of the Chinese stock market, the numbers started at the end of 1992 through the end of August of this year. So that's about a 30-year period, give or take. The annualized return for that MSCI China index, it looked purely at what was going on with the Chinese stock market, wound up being 2.2% on an annualized basis. Compare that to the MSCI Emerging Market Index, which was slightly under 8% at 7.8% over that period of time. The S&P 500, close to 11, 10.7 over that, again, comparable period of time. And then you've got, supposedly, an economy in China that's growing at 10% per year during that 30-year window, but yet your return is only 2.2%. So be careful, because just because you have economic growth, particularly when it involves a communist state, it doesn't mean that that translates to overall stock market performance. Hear that number again. Average annualized return of the MSCI Chinese stock market index over the past 30 years, going back to its inception in 1992, 2.2%. So there's this myth that somehow you get these great returns by investing in China. And that's not to say that there's some individual companies out there, but here's the thing. This is not a country, China, that does not like being in full control over its people and over its finances. Look no further than the other headline of this past week or so, where China's central bank said that all crypto-related transactions of any kind are illegal. Furthermore, it's illegal for overseas exchanges to provide services to residents in China through the internet. Why? Because according to the People's Bank of China, which is their main bank, their kind of central bank, they want to maintain national security and social stability. And remember, crypto facilitates the exchange of money and transactions and things like that in a fully anonymous manner. Chinese don't like that when you start to get anonymity in there, right? And then from that perspective, think about what's going on politically, right? So next March, the National People's Congress meets, and Chairman Xi is aiming to become lifetime chair. But the problem is, as you might well imagine, as he's been cracking down on these industries, a lot of the party elites have been hit, and particularly in their pockets. So he doesn't have as much fans among the party elites as he once had, because he's alienated so many of them with his personal agenda and crackdowns and things like that. So he needs the support of the masses. Well, in China, there's like 600 million or so Chinese who live on monthly income of less than $160 per month. Let me say that again. 600 million people are in China living on less than $160 a month. That's almost double the population of this country, for comparison purposes. So when we talk about wealth disparity, maybe we should have some perspective on just how narrow the gap is in this country, particularly in comparison to other countries. So if the message is, I'm going to get the masses behind me, Xi looks like a strong leader. If he's bringing down Chinese billionaires and forcing them to share their wealth, after all, that's an easy target. I'm going to take the money out of the guy that's got it, that created a business, that created an enterprise, that provides a valuable good service, and those are going to be my targets. And I'm going to make them share the money with everybody else. And wait a minute, where have I heard that before? I'll have to think. Give me a minute. I'll think of it. I've heard that argument before. It'll come to me. Don't worry. Anyway, understand that when you have policies of advancement of the state and retreat of private enterprises, okay, and common prosperity, there's another one that I've kind of heard kicking around before too, then, you've got this constant political need to find enemies to purge, enemies to attack, particularly if they are businesses. Does that sound like an environment that is investor friendly? Not in my opinion, that's for sure. I think the risk to foreign investors, to foreign firms, should be crystal clear. Chinese corporations and investors are in large ways hostages to the whims of their leader. Executives, companies, entire industries formerly favored have been stripped of power and value without warning. The examples are so many that have occurred over the course of the past 12 months where you've seen hundreds of billions of dollars of value lost. Whether it's Ant Group. Ant Group is a financial, is a tech firm. Last year it would have gone initial public offering. It would have been the world's largest. It was blocked. Alibaba, founder Jack Ma, all of a sudden disappears for a few months, not really sure where, and that company's hit with a $2.8 billion antitrust suit. Various educational companies, 70% drop this summer after they were told, we don't want any of these private educational companies out there. These are significant events that folks need to be paying attention to. We're going to take a break. We're going to come back. We're going to wrap up this China story. I told you it was going to be a little deep. And then we'll shift over to getting Kristen on the show and talking about some of the tax changes coming out of Washington. All that and more on Dollars and Cents. So let's wrap up this China conversation because we're going to bring in our fellow certified financial fiduciary and CPA at Nelson Financial Planning, Kristen Kelly, to talk about some of these tax proposals that are floating around Washington. Last week on the program, we covered income taxes, capital gains. We got some more stuff we want to cover with that. But let me just kind of finish up this China conversation. And again, emphasize the numbers, right? Over the course of the past 30 odd years since the MSCI China Index was developed, your annualized return 2.2% for the Chinese stock market. That's not very good, particularly when supposedly the economy over there has been growing by 10%. What's happening is that we're seeing this ongoing trend of China shifting policies so that whole industries and companies and executives are finding where they went from favored status to unfavored status. We gave you some very specific examples at the end of the last segment. Alibaba, Ant Group, various educational companies, all of those companies woke up one day and saw that their fortunes literally had changed dramatically. Despite this, well known, this is not, this is a lot of stories all kind of coming together over the course of the past 12 months. You have major financial institutions telling people to continue to load up in China. It doesn't matter whether it's Vanguard, JP Morgan, Goldman, whatever the case may be. In particular, BlackRock, who's the world's largest supplier of ETFs and index funds, hence they have an incentive, is calling for investors to triple their allocation to Chinese stocks. We think the risk is particularly great, particularly for indexes or ETFs that track emerging markets. emerging market index or ETF is going to be about a third made up of China. Bottom line for investors is this: know your allocation, know the mix of stocks versus bonds versus cash, but also know where those companies are located. At the end of the day, investors really shouldn't be having hardly anything other than a tidbit in terms of direct exposure to Chinese companies. Maybe that's 1%, 2%, 3%, because the reality is the Chinese government has been meddling with their economy and their companies and their businesses and their stock market since the 19th century. Anyone who tells you that you need to invest more than a tidbit in China in that kind of environment is simply asking you to bet that the future will look nothing like the past. And I'm sorry, but that's not going to be the case. So be aware of that. Check your allocation. Specifically, we often talk about checking the allocation, stocks, bonds, cash, things like that. Specifically, really look at the country allocation. All right, we're going to shift gears. Welcome Kristen into the conversation. So it was kind of a little bit of a fun week, or at least on Thursday. Tell us what we all did on Thursday, because you spearheaded that effort.
Right. So we are, as a team, Nelson Financial Planning, participated in the Simply Iowa Track Shack 5K. It was downtown at Lake Eola. It was a great time. We got some new T-shirts, and we all had a good time.
Well, that is good, and we all were walkers. So you signed us all up as walkers, so no one had to kind of really bring out the running shoes.
That's right. Didn't want anybody feeling bad about not running.
Well, and I think Garrett was disappointed on that. He was hoping he wanted to see just how I would kind of stack up with the running that I've done in the past.
Mm-hmm.
But
I think he wanted you to go against Chet and see how that would go.
Chet's like half my age and actually does some boxing, so I think I'll give it to Chet. Also, I want our listeners to know you were just accepted to a pretty important Leadership Academy for CPA. So tell those listeners a little bit about that.
Yes. So I applied to the FICPA Leadership Academy and was recently accepted. So it's a pretty cool program. They're looking for young CPAs that are looking to further their career and boost their professional leadership skills. So it'll be a good time. I'm going to go to a couple different cities and learn some leadership and management skills. Awesome.
Now that is good stuff. Now, what you can do with those management skills then that you will learn from that academy is you need to take that and explain what that's all about to the folks in Washington. Because there's an absence of leadership there. That is for sure on both sides of the aisle. We're not going to take political shots. I think I took a couple of them as I was talking about the China thing. But last time we talked about income tax potential, underscore potential, income tax changes, potential capital gains changes. What are some of the other tax things that they're thinking about potentially looking at making some changes on?
Yes. So another big one that we didn't touch on last week is they want to expand the net investment income tax to include ordinary income derived from trade or business. So just backtracking a little bit to describe what the net investment income tax actually is. So this is a tax at a rate of 3.8% that applies to certain investment income of individuals, estates, and trusts. So for individuals, it applies if you have over $250,000 of income from married filers and $200,000 for single and head of household. So the tax applies to interest, dividends, capital gains, rental income, so passive income, like it sounds like, investment income. So what they're looking to do is expand this net investment income tax to be taxed on your ordinary income derived from pass-through business income. So stuff that was typically not taxed at this investment income or investment income tax will now be hit with the 3.8% if you are over certain thresholds. So those thresholds are going to be $400,000 for single filers and $500,000 for joint filers.
So, and obviously this stays with the theme of it's obviously higher income workers. But what's interesting about this change that they're looking at on this investment income tax is, as the name suggests, previously it was on dividends. capital gains, things like that. Passive activity. Now, though, if you're a business owner, now that profit, whether it's an S corp or anything along those lines, now you are going to have to now pay this investment income tax on what is in essence earnings.
Right.
Okay, so that's a little bit of a change. What else?
So additionally, just kind of along the same lines, so we touched on this last week, but the qualified business income deduction, the 199A deduction, which is that 20% deduction for pass-through businesses. So if we kind of tie these two in together, so let's say you're a married filer with over $500,000 of income, you'll be hit with this new net investment income tax that's on your active business earnings, as well as you won't be able to take the 20% deduction. So if you fall over that $500,000 for married filers and $400,000 for single filers, and you have your own business, you might want to do some tax planning because your tax return is going to look a little bit different next year. So
that qualified business interest deduction, in essence, that's going to go to zero if you're above those income thresholds.
Right.
Yeah. So if you're having a good year, and look, if you're doing well where you're getting above these thresholds, that's great. The reality is oftentimes no business is perfectly stagnant, right? So if you wind up being fortunate enough to have a good year and you get above these thresholds, then that's where you're going to be hit with all these extra taxes. We're going to take a break. We got more to talk about coming up next here on the program Dollars and Cents on News Radio WFLA Orlando. Welcome back to the program. We're joined in this segment once again by our fellow certified financial fiduciary at Nelson Financial Planning, Kristen Cayley. She also happens to be a CPA as well, talking about some of the proposals that are floating around in Washington that will impact your taxes. Certainly the ones we were talking about before. I mean, those are high income thresholds. But the reality is, if you have a good year in your business, then you can certainly see that you might move above those thresholds, and that's where a lot of the additional taxes would kind of come into play.
Exactly. Yes. And
there are more as well. Like if you get really high, there's another one that would come into play.
Right. So another one that's come into play is this 3% surtax for individuals with over $5 million of income for joint filers and $2.5 million for single filers. So very high income, but that would be an extra 3% surtax. So
almost like a wealth tax, which is again the concept that they've certainly been kicking around before. All right, so that pretty high income. Okay, that's probably relatively limited. We hope it's not limited in your case, but for the vast majority of Americans, it wouldn't apply. But this next one would potentially, because these have to deal with changes to your retirement account. So let's talk about some of the stuff that they're thinking about doing on that.
Yeah. So the first change, again, from high income earners. So they want to limit any contributions to any IRA, Roth, traditional, if the total value of your IRAs is over $10 million. So the reason this law came in, or this proposal came into play, is because the billionaire founder of PayPal used his Roth IRA to buy 1.7 million shares of PayPal back in 1999. So back in 1999, that was worth about $2,000. 3 years later, the company went public, and today his Roth IRA is valued at $5 billion. All
it takes is one person to kind of mess it up for the rest.
Exactly. So essentially, under previous law, this PayPal founder has $5 billion of tax-free income. So the House was...
It's good financial planning.
Yeah, it is. It really is. But the IRS and Congress, not a fan of all that lost tax dollars.
Yes.
So they may force him to pull out the $5 billion from his Roth IRA, but that's still under speculation. But the new proposal would limit any contributions to an IRA if you have over $10 million in it.
But that sounds like a big number, and it is. But look, if you're starting out, for anybody in their 20s, I mean, the only place that they're going to have to save for their retirement is going to be like 401ks, IRAs, things like that. And it's not like 30 years ago when people also had the option of a pension with their employer or something like that. And you kind of run some numbers, and it's not crazy to think that folks that are saving 10%, 15% of their income, and they do that consistently starting in their 20s, you could get to that 10 million number without assuming too big of a rate of return. And see, that's where then you should start to see the impact of where these tax changes would certainly kind of come into play and hit a much broader range of folks. And if your IRA and it's the combined IRA and Roth, and that would also include like a SEP, it would include all retirement accounts, right? You're looking at the whole picture. So what happens if you go above 10? Then what are you gonna do?
So under the proposal, you're required to withdraw 50% of the value that you went over 10 million within the next tax year, but it's still under speculation.
Yeah. Well, that one almost like a disincentive to do well on your retirement planning. That really kind of troubles me a little bit. But another item that they're looking at is the Roth. So tell us what's going on that.
Right. So they're looking to limit backdoor Roth Iras and also Roth IRA conversions. Mm-hmm. So to make all these new proposals make sense, just kind of want to touch on what the rules of a Roth IRA are in the first place. So with a Roth IRA, your after-tax contributions, which are capped at $6,000 if you're under 50 and $7,000 if you're over 50, are added to a Roth IRA, and you can achieve tax-free growth if you've held the Roth IRA for at least 5 years and if you are over 59 and a half. So you can always take out your contributions without any tax consequences, but if you withdraw before the age of 59 and a half, you're hit with the early withdrawal penalty of 10%, as well as ordinary income taxes on the growth, only the growth, not your contributions. So up until now, the income thresholds to contribute to a Roth IRA are $140 for single filers and $208,000 for married filers. So up until now, there's been a way to get around those income thresholds by doing what we call a backdoor IRA. So with a backdoor IRA, you can get around those income thresholds by contributing to a traditional IRA and then converting that money over to a Roth IRA.
And that's a technique that we've used for many folks here at the office, where you put the money into the IRA and then really, to time it correctly so you don't have really any big tax issues, literally the very next day you would then do that conversion. So that's really been a great opportunity for folks to be able to do that Roth through the back door. So that back door is getting closed pretty tightly.
Right. So they're looking to eliminate it for filers over $400,000 for single filers and $450,000 for married filers starting next year. So if you're looking to make any sort of backdoor IRA conversion, you might want to do it before the end of the year because it's going to be pretty tight next year.
Right, in terms of the income limits and just the ability to do that. Yeah. So what else is going on with the with those options anyway? In terms of those Roths. I mean, some of that stuff doesn't really actually take effect for a few years. What's the immediate impact on some of those changes?
Right. So another proposal that's floating out there related to these Roth conversions is that they want to limit Roth IRA conversions for filers with those same income parameters, the $400,000 for single, $450,000 for married, and make it so they can't do Roth IRA conversions, which is where you pull money out of your pre-tax account and convert it to Roth money. And when you convert money like that, whatever you take out of the pre-tax account is taxed on your income tax return as income for that year.
So lots of changes coming up on the Roth side of the equation, and then what's the other thing? They got to figure out some money for the folks that do all of this, right? What's going on that part?
Right. So another big thing that's out there is the Congress wants to set aside $80 billion for the IRS to advance their audit abilities and just being able to, have the technology to keep up with what's been going on.
$80 billion to the enforcer, huh? Okay, all right. They're hoping to uncover a bunch of I don't think Americans are that big of a cheating nation, but apparently that's okay. The IRS might think that. All right. So we got 80 billion going there.
Yeah, so what they're speculating is a significant portion is going to go towards crypto transactions. So as you all probably remember, when you filed your tax return last year, everyone had to answer the question at any time during the year: did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? So that was just their first step in kind of pinpointing who might be involved in these crypto transactions. And now they're just advancing their technology to try to pinpoint.
That ties in to the conversation we were having earlier in the program about China making all cryptocurrencies illegal. They're not going to be illegal here, but they're going to be highly, highly regulated, and they got $80 billion to help regulate that. So anyway, thank you for joining us once again.
Yes.
Good stuff.
Thanks for having me, Joel.
My pleasure. These were all proposals, so it's important to kind of get them on the table. When things become actual law, then we're certainly going to have you back and talk about what actually changed. We're going to wrap it up and get on out. Thanks for listening to Dollars and Cents with Joel Garris.